Recording in progress.
Hello, welcome to Accurate Consult channel. I am Sheye Olokere. I'm the founder of Accurate Consult. This short video is on the important changes that will affect personal income tax for 2024 and beyond. I'd like to share a couple of slides with you guys. Yes, this is Accurate Consult. What we do, as Ella said, I'm a CPA chartered accountant, and I have over 10 years professional experience in finance and accounting. I'm trained in Canadian taxes by one of the foremost tax firms in Canada. In terms of what we do, we help small businesses with their corporate income tax. In terms of personal income tax, we focus on complex tax situations. If you have a complex tax situations, we can help you to complicate your tax situations to make it seamless. For small businesses that want to set up a new business, we can help you structure your business in such a way that at the onset is properly set up. In terms of payroll, if you want to provide payroll services to your staff, we can help you process salary payment and remit electronic returns to CRA and other regulators. And you don't need to send manual returns to CRA and other regulators. This service also provides pay stub and T4 to staff. In terms of business consulting, we can help businesses who want to gain competitive advantage over peers by conducting industry and competitive analysis. And if you want your financial statement packages to be prepared and validated by an accounting firm, you can connect with us. Moving on to the changes for 2024. This slide shows the tax rate applicable for 2024 and 2025. Canada operates a marginal tax systems and a progressive tax regime, whereby the higher you earn, the higher your tax payable. This is the marginal tax rate applicable to this taxable income. So, for example, the basic taxable income is from 0 to 57,375 for year 2025, while for 2024, it's from 0 to 55,867. Now, the goal is, how do you reduce your taxable income? Your taxable income, not your net income now, your taxable income. How do you reduce your taxable income? Because this tax rate will be applied on your taxable income. The next slide shows the various tax deductions that we can use to reduce our taxable income. But how is our taxable income derived? This table below shows an example from your salary income plus your other personal income other self-employment income. So if you have a self-employment income or a sole proprietor that is not incorporated, another income, maybe you sell a car or other income earned from maybe selling online, all this income will be added to your salary income to arrive at your total income. Less tax deductions to arrive at net income minus other deductions to arrive at your taxable income. As Zella said, the goal is how do you reduce the taxable income? Because this tax rate will be applied on your taxable income. Now, I would recommend that you watch out for items that will impact your taxable income. These are the list of tax deductions that will be deducted from your total income to arrive at your taxable income. For example, registered pension RRSP, first home savings account, annual professional dues, childcare expenses, disability support deduction. If you have a sole proprietor business and the business has some investment loss, or maybe moving expenses. If you need to relocate from one province to another, as an individual for work, if you get a new job and the distance is more than 40 kilometers and you need to relocate, or you get maybe a new admission in another province and you need to move as a student to that province, then you can use that. You can claim moving expenses. Support payments made for those that are supporting, for those that have breakdown in their marriage, maybe they are divorced and they are supporting their spouse so they can claim such. Now, carrying charges, if you borrow, let's assume you borrow $50,000 to invest in stocks, the interest expense you pay on the amount borrowed can be used to reduce your taxable income. Then deduction for CPP, then other employment expenses for those that work from home. You can claim this if you get the relevant document T2202 from an employer that you work from home in 2024. Then religious personnel, clergy can deduct expenses used in managing their homes. So these are the items that we can use to reduce our taxable income. So the goal is, how do you reduce the taxable income? Because this marginal tax rate will be applied on your taxable income. So for example, the first 55,867 will be taxed at 15%. So let's assume someone's taxable income is like 80K. So 80K minus this, the remaining will be taxed at 20.5%. So the goal is reducing your taxable income. Now, this is another key rule that was implemented in 2023. Now there's an amendment to this in 2024 and it relates to short-term rentals. The government wants to encourage homeowners, property owners, to rent their property for long term, more 12 months or beyond, because of shortage of rental properties. Governments want to disincentivize people. So there are strict rules on this. You need to watch out for this if you operate a short-term rental or if you pay people for staying at your property. The government will be expecting such property owner to report such income. So for example, if I'm a sole proprietor and I stay at your property, I will want to use the rental expense, what I pay to you, to reduce my business taxable income. So if I report such on my own taxes, then government is expecting you as the homeowner to report such as your rental income. Now, the addition to this in 2024 is that CRA and federal government has given city administrators the power to review your short-term rentals, if it's compliant or not. You need to confirm from your city administrator that your rental property is compliant for short-term purpose or not. Because if it's not compliant, you won't be able to claim any rental expenses, and it's going to increase your taxable income. Looking at this scenario, this taxpayer is compliant, while the other is not, is what this is compliant and why this is not compliant. So imagine you have, from your rental, you make a rental income of $60,000 and you have rental expenses of $40K to reduce your rental income. So the taxable income on your rental will be $20K. Now, assuming the taxpayer has an average tax rate of 20%, so 20% on this taxable income will be tax payable, will be $4,000 on this 20,000 taxable income if the renter is compliant. But if the rental, short-term rental, is not compliant, you won't be able to claim this $40,000 to reduce your rental income. So you'll be paying tax on the entire $60K, and 20% on this $60K is $12,000. So imagine there's a differential of $8,000 if your short rental property is compliant or not. So the advice is reach out to the city administrator to confirm if your rental, short-term rental, is compliant or not. Because if it's not compliant and you claim compliance, CRA can get back to you, ask for supporting documents, and if you cannot justify that, your claim will be rejected and it's going to increase your taxes. So please, if you operate a short-term rental, less than 12 months, Airbnb, and go, reach out to the city administrator to confirm compliance. Now, this next slide is on capital gain. There has been a lot of debates, even in the political space, on capital gain in 2024. Firstly, what is capital gain? Is the gain on capital assets or tangible assets. Capital gain is calculated as sales price minus acquisition cost minus selling expenses. Selling expenses are maybe you need to renovate before you sell your property or your asset. These are selling expenses, or you pay maybe a broker some fees to help you package your property or sell. Now, in terms of capital gain taxes, there are three different scenarios. So the first two scenarios are applicable before 2024. The first one is the standard capital gain. So the standard capital gain is 50% on the capital gain calculated, sales price minus cost minus selling price. The tax you pay will be 50% on this. 50% on this. Now, this is applicable to maybe if your property or your asset is not primary resident. For people that is a primary resident, the flipping rule will apply. If you sell your primary resident, your only property within 365 days of purchase, less than 1 year of purchase. So if I buy a property, my only property, and I sell it less than a year, government will assume I'm a flipper and I'm going to pay 100% on the total gain. 100% on the total gain. The whole essence is to disincentivize, to discourage speculators in the market, to ensure stability in the real estate market. Now, these two are applicable before 2024. So the standard capital gain is 50% if you have a property and you sell it and it's not your primary residence and you sell after 1 year, after 65 days, 50% of this gain will be taxed or if you sell less than 1 year, less than 65 days, 100% of the gain will be taxed. 100% of the gain. Now, this third rule was introduced in 2024 for 2024 taxes. So what they're saying, even though you did not sell within 365 days, but if the capital gain is more than 250K, government in the political space, they believe is that people that are rich have property and the capital gain on such property will be more than 50K. That's why this rule is being introduced. So if the capital gain is more than 250K, you'll be charged 67% of this capital gain. So you need to watch out and be calculative on disposal of your property. So this table shows how the scenario affects the three different rules. So for example, if someone sell his property for 800K and the acquisition cost is 400K and the selling expense is 20K, the total capital gain will be 380K. 380K. Now, if this is your primary residence, there is no capital gain. You are not going to pay any tax. But if this is not your primary residence, you have more than one property and it's not your primary residence, and the capital gain is more than 380K in this case, the third scenario will apply. You're going to pay 67% on this capital gain, assuming your average tax rate is 20%. So it will be 20% times 67% times the capital gain. So the tax you'll be paying on this gain will be 76K. But if you are a flipper, you sell your property less than 365 days, you're going to pay this 76K. If you are not a flipper, but the total gain is more than 250K, you're going to pay these total taxes. But let's assume your total gain is not more than 250K, this will apply to you. So in some way, government wants, the whole essence is to encourage taxpayers to hold their property more than 12 months, not to flip property to cause uncertainty in the. So you need to watch out for this. Now, this is one of the major rules that was introduced in 2025 called the Digital Platform Businesses. And this is applicable to everyone that sells online. Now, the rule is to ensure that people that trade online pay their own share of what? Taxes. If you sell items from your garage and you are not paying taxes on it, if you sell items online. Now, what government has done is government has mandated the likes of eBay, Etsy, and Co, PayPal that collect payment online to report transactions to CRA and other regulators, because they have your social insurance number when you register with PayPal, when you register with eBay. So when such transactions are reported, it will be attached to your social insurance number. So please be ready to pay taxes on your digital sales. Now, this is applicable if your sale or your revenue, the net revenue less commission, is $2,800 and above, or you have a total of 30 transactions in a calendar year. The likes of PayPal and eBay are mandated to report you. Now, when you are reported, the CRA is expecting you to report such revenue so that you can pay taxes on them. Now, for those that still don't collect payment online, when you do transactions on Facebook, Instagram, WhatsApp, maybe Telegram, and people transfer to your bank account and payments are not being collected online, government is likely modifying this rule to ensure that all transactions are captured Yes, because they are working with industry experts. So we encourage you, please keep proper record of your transactions. Please keep proper record of your transactions because the law most likely will be extended to those platforms that don't receive payment online. And if you need maybe a, a template that can help you to capture the transactions, you don't have an accounting software to capture transactions. If you need a template to help you capture that, I'll be providing a Google form you can fill, where you can provide your email address, and I can share such templates with you to properly capture your financial transactions. So that will be provided in the comment section. That's the end of the important rules that will affect your taxes in 2024. Please subscribe to our YouTube channels so you can receive notifications when we make videos, new videos on taxes and other related topics. Thank you for watching this video. See you in the next video.